If you've been investing for some time, then you probably know who Warren Buffett is. Who doesn't? This man is one of the world's richest people, consistently ranking high on the Forbes list of billionaires. His net worth was listed at $100 billion as of June 2022. Buffett is also known as both a savvy businessman and generous philanthropist. You already know that this man is one of the world's most successful investors. Therefore, it's not surprising that Warren Buffett's investment strategy has reached mythical proportions. Buffett follows several important tenets and an investment philosophy that is widely followed around the globe. So just what are the secrets to success? Hey, welcome to Stock Market Mate. Today we'll talk about some investment tips for beginners according to Warren Buffett. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Before we get into the good stuff, let's talk about Warren Buffett's background first. Warren Buffett was born in Omaha in 1930. He developed an interest in the business world and investing at an early age, including in the stock market. Buffett started his education at the Wharton School at the University of Pennsylvania before moving back to go to the University of Nebraska, where he received an undergraduate degree in business administration. Buffett later went to the Columbia Business School, where he earned his graduate degree in economics. Buffett began his career as an investment salesperson in the early 1950s, but formed Buffett Associates in 1956. Less than 10 years later, in 1965, he was in control of Berkshire Hathaway, along with his long-term business partner and vice chairman, Charlie Munger. His stocks have consistently returned an average of 20% annually, with an annual return that is double that of the S&P 500 over time. Berkshire has generated a total return of 2.8 million% as opposed to the measly 23,000% of the S&P. He's achieved this by sticking to a very basic set of guidelines that we'll discuss today. Charlie Munger perfectly summarized for us the set of rules Buffett follows. We must first deal with issues that we are capable of comprehending, and once we have passed that filter, we must have a company with some inherent qualities that give it a long-lasting competitive edge. And of course, we would much rather have talented and honest management in place. Furthermore, no matter how beautiful something is, it will never be worth an infinite sum of money. As a result, we must set a price that makes sense and provides a margin of safety. It is a really simple set of ideas when compared to the natural business attitudes of life, and the reason our ideas have not caught on more quickly is that they're too simple. Charlie is correct. The process is only 4 steps long, and we should point out that at the beginning of the video that it remains the same strategy regardless of market conditions. Therefore, these 4 investment pillars would always be the same, regardless of whether this video was labeled Buffett's advice for 2022 or Buffett's advice for 1984. However, in 2022, we will undoubtedly have to deal with some difficult new considerations while negotiating our investment. The stock markets are ridiculously expensive right now. This year, interest rates are probably going to increase because of the high level of inflation. So let's watch this video to hear Warren Buffett's suggestions on each of these 3 key factors. Number 1. Overvalued stock markets. We begin with the issue of the inflated stock market. Given how pricey everything is this year, how should we go about investing? If you're an active investor, you should be aware that there may not be many possibilities this year to purchase discounted stocks in our area of expertise. This is what Warren Buffett remarked about the situation in his annual letter to shareholders from the year 2019. He stated that we hope to invest a large portion of our excess liquidity in companies that Berkshire will always control in the coming years. However, those chances are not promising in the near future. Prices for companies with good long-term prospects are currently sky high. Yes, Buffett is attempting to acquire entire companies, whereas we are only attempting to acquire a few shares. But in the end, everything is the same, and he has undoubtedly had trouble finding somewhere to invest his money during the past year or two. He doesn't, however, only lose money on overpriced stocks. That is the ultimate investment sin. Instead, he just keeps saving money and waits patiently. The amount of cash held by Berkshire Hathaway increased from $84.4 billion in Q3 2016 to $149.2 billion in Q3 2021. It is therefore far from ideal. But keep in mind that you gain money while you wait, not when you buy or sell. You don't need that many fantastic stocks in your lifetime, as Warren Buffett points out. So be patient and wait for the proper opportunities to present themselves. Also, avoid buying ordinary assets in an inflated market. According to Buffett, all you need are 3 wonderful businesses in this life to do very well. And you've heard him say this countless of times already. So, wait patiently until the market finally provides one for you. But Buffett frequently advises the majority of investors to use another type of investing approach, which is, of course, passive investing. and passive investors who are just under dollar cost averaging to trade stocks in 2022 should continue to do so without a doubt. When I purchased my first stock on March 11, 1942, investing in an index fund would have been the best decision you could have made. And just like you would if you purchased a farm, stop reading headlines and stop thinking about stocks. You simply purchase the formula, delegate management of it to the tenant farmer, and I emphasized that you could invest $10,000 in an index fund that reinvests dividends. I then took a brief break to give the audience a chance to predict the total, which was $51 million. We love that clip so much. It is not important for the passive investor to try to buy at the ideal periods. The fundamental principle of the dollar cost averaging approach is that you keep investing in market tracking securities at the same periods, come rain or shine. And if you continue doing this for a very long time, you will eventually achieve the market's average return, which is, incidentally, between 8% and 10% annually. As Buffett said, so I would choose a broad index, but I wouldn't add a lot at once. I would do it gradually since investing in index funds entails declaring your belief that American companies would perform relatively well over the long term. But I lack the knowledge necessary to predict winners or the best times to bet. There is nothing wrong with that. I lack the knowledge necessary to predict winning times. I occasionally believe I am knowledgeable enough to predict the winner, but this is infrequent, and I most certainly can't choose the winners by going through the entire list and selecting some as winners and others as losers. The key is to invest gradually over time rather than making an implicit gamble by investing a sizable sum all at once if you believe that businesses are sensible places to keep your money over the long term. Therefore, as Warren Buffett just said, passive investors shouldn't care whether the market is high or low. Simply keep going. Avoid reading headlines. Never glance at a chart. Just stick to your plan. If you think very long term, the stock market will be your friend. Even if you invested everything and the market plummeted by 50% the next day, long-term passive investors would not suffer a catastrophe. It only took 5.5 years to get back where you were after the GFC, the world's greatest financial crisis since the Great Depression. 9 years later, the market has nearly tripled in value since that time. So yes, although the market is now at a high, nothing terrible has happened. We must exercise patience and refrain from making foolish decisions as active investors. We must carry on as we always have as passive investors. Strive to maintain that average. Number 1. Inflation. Next up is inflation. What about it? Over the past 12 months, it has been a major story, and for a good reason. Inflation in the US has reached 6.8% annually, and it appears likely that it will continue to be a major issue beyond 2022. This time is fascinating. Due to the fact that we have a monetary policy with interest rates that are almost zero, we have never fully understood what it means to shovel money, and it is quite enjoyable. But there's one thing to keep in mind at all times in economics. Never focus on just one thing. Warren made the statement in May 2021 before inflation really took off. You can tell he anticipated inflation. It's true what Buffett stated about not just doing one thing in economics. What happens next must be considered. And what are you aware of? Money printing and zero interest rates finally caught up with us. Inflation is at a high, so Mr. Buffett, what should we do? Buffett has really already addressed this issue in the past. We're going back to 1982 when US inflation had just started to decline after reaching a peak of roughly 20%. In 1982, Buffett specified the types of companies we should purchase during inflationary times in his annual letter to shareholders. Such preferred firms, he stated, must have two traits. The ability to increase prices without fear of significantly losing market share or unit volume is the first. The second is the capacity to accommodate larger dollar volume increases in business, which are frequently driven more by inflation than real growth, with minimal additional capital investment. First off, he's referring to companies that can raise prices without facing any consequences, which unquestionably aids in reducing the effects of inflation. But what company could significantly raise costs without losing customers? People would undoubtedly search elsewhere for a cheaper product. Unless you have a moat, that is. If you possess a competitive advantage, no. Apple consistently raises its pricing above those of its rivals without having an impact on its market share. People don't switch to other beverages when Coca-Cola increases its prices. Interestingly, they are currently two of Warren Buffett's largest investments. Making sure the businesses you're considering have a competitive advantage is the single most crucial action to take during inflationary situations. Something that guarantees they will maintain their clientele and, consequently, their market shares even if prices are raised. Second, according to Buffett, we should look for companies that can expand their sales significantly with only a modest increase in capital investment. In other words, businesses that can generate a lot of revenue without having to invest a lot of money to do it. As a result, you must consider businesses with highly scalable business models. Facebook doesn't really need to create another app in order to increase its ad revenue. They simply increase the frequency of their advertisements. Ford, on the other hand, needs to build more factories or recruit more workers to produce more cars if it wants to increase its income. That job is significantly more difficult. As a result, in times of inflation, seek out businesses with a competitive advantage and those that are easily scalable. Number 1. Interest rates. Let's finish up by discussing interest rates. The Fed has stated they may raise interest rates 3 times in 2022. What is Buffett's opinion on interest rates? Interest rates, are ultimately what determine the value of things and what matters most. The US Treasury also auctioned some 4-week notes and Treasury bills on Thursday. The average cost is listed as $100 million, with 6 zeros. The money was received by the Treasury at 0, so the so-called highly risk-free group short-term Treasury bill has been drastically reduced, and that serves as the benchmark by which all the other values are judged. If I could lower gravity, it would be pulled by around 80%. I'd be leaping in the Tokyo Olympics. And in essence, if interest rates were 10%, valuations would have changed enormously because everything would be worth so much more. That generates income since the risk-free rate is currently producing enough amount. That clip, which is another excerpt from the May 2021 shareholder meeting, discusses in detail why the market is currently at an all-time high. The huge money managers are simply not receiving a return on bonds, since interest rates are at 0. Therefore, instead of keeping their money in bonds, they invest it in the stock market to chase returns that increases values. The dynamic Buffett was referring to is this one. What gravity is to matter, interest rates are to stock market valuations. The easier it is to jump, the lower the gravity. It becomes much tougher though, as gravity is increased. The current stock market is the same. Because interest rates are so low, it is quite simple for stock market valuations to increase. There is a lot of money coming into the market, but in 2022, things will start to turn around. Interest rates will begin to rise, and as they do, gravity's pull will become greater, and it will become more difficult to jump. Therefore, even though you shouldn't let the macroeconomic environment influence your own personal investing, it's still important to be aware that valuations may be under pressure in 2022, 2023, and so forth, especially for overvalued stocks as new bonds become more alluring and interest rates rise. So there is no doomsday prediction. Just be aware that this could happen over the coming several years. Be prepared as a result. And there, my friends, are a selection of Warren Buffett's advice that, hopefully, will assist us in navigating the major investing difficulties of 2022. We hope you found this video entertaining and useful. If so, kindly click the like button. This considerably aids the video's ranking on YouTube, and it aids in the channel's growth. So feel free to leave a like and subscribe if you want a simple method to support our work on YouTube. Absolutely free, of course. We appreciate your time, and we will see you soon. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!